The life insurance scam that's costing you $847 per month. A life insurance agent just pitched you whole life insurance as an investment vehicle that builds cash value while protecting your family. You're paying $500 per month for $250,000 in coverage. Sounds good, right? Wrong. For that same $500 per month, you could buy $2 million in term life insurance for $80 and invest the remaining $420 in index funds. After 30 years, the term plus investment strategy leaves you $680,000 richer than whole life. I'm about to expose the biggest insurance scam in America and show you exactly why 98% of people should never buy whole life insurance. What whole life insurance really is. Whole life insurance combines a death benefit with a savings component. Part of your premium goes to insurance coverage, part goes into a cash value account that grows slowly over time. Agents love selling it because they earn 50% to 110% commission in the first year. On a $500 monthly premium, that's $3,000 to $6,600 in their pocket. They pitch it as, it builds cash value you can borrow against. It's permanent coverage for life. It's a forced savings vehicle. The cash value grows tax-deferred. All technically true, but what they don't tell you is that whole life is the most expensive, least efficient way to get insurance and save money. The real cost comparison. Let's compare two 35-year-olds who need $500,000 in life insurance coverage. Person A buys whole life insurance. Monthly premium, $500. Annual cost, $6,000. After 30 years, paid $180,000 in premiums. Cash value at age 65, approximately $110,000. Net cost, $70,000 for coverage plus $110,000 cash value. Person B buys term life insurance plus invests the difference. 30-year term life for $500,000, $50 a month. Monthly investment in index funds, $450 per month. Annual cost, $600 for insurance, $5,400 invested. After 30 years, paid $18,000 in insurance premiums. Investment account at 8% average return, $612,000. Net position, $612,000 in investments. Person B is $502,000 better off than Person A. That's not a typo. Over $500,000 richer by avoiding whole life and using term plus investment. Why whole life has terrible returns. Whole life cash value grows at 2% to 4% annually in the early years, gradually increasing to 5% to 6% after 20-plus years. Compare that to stock market average, 10% annually. Even conservative 60-40 portfolio, 7% to 8% annually. High-yield savings, 4.5% to 5% right now. The insurance company takes your premiums, invests them, earns 8% to 10%, and pays you 3% to 5%. They pocket the difference. On top of that, the first 2 to 3 years of premiums go almost entirely to commissions and fees. Your cash value barely grows at all early on. If you cancel in year 5, you might get back 30 to 50% of what you paid in. The cash value loan trap. Agents love to say you can borrow against your cash value tax-free. Here's what they don't mention. You're borrowing your own money and paying 5 to 8% interest on it. If you die with an outstanding loan, the death benefit is reduced by the loan amount. If the loan plus interest exceeds the cash value, the policy can lapse and create a massive taxable event. Why would you pay interest to borrow your own money when you could just have that money in an investment account and withdraw it with no interest? When whole life actually makes sense. I'm not saying whole life is always bad. There are specific situations where it works. You're extremely wealthy and have maxed out all other tax-advantaged accounts. If you're contributing $66,000 to your 401k, maxing HSA, Roth IRA, and still have money to invest, whole life can provide additional tax-deferred growth. But this applies to less than 1% of people. You have a special needs dependent who will need lifetime care. Whole life guarantees a death benefit whenever you die to fund a special needs trust. You own a business and need permanent insurance for buy-sell agreements. Some business succession plans require permanent insurance. You're uninsurable for term insurance due to health issues. Whole life policies are harder to cancel for insurers, so they might be your only option. For everyone else, 98% of people, term life insurance is the right answer. What term life insurance actually costs? Here's what term life insurance actually costs for healthy, non-smoking individuals. 30-year-old. $500,000 coverage, $20 to $30 a month. $1 million coverage, $35 to $50 per month. 40-year-old. $500,000 coverage, $35 to $50 a month. $1 million coverage, $60 to $90 per month. 50-year-old. $500,000 coverage, $90 to $130 a month. $1 million coverage, $170 to $250 per month. These are 20 to 30-year term policies. At the end of the term, you don't need life insurance anymore because your kids are grown, your mortgage is paid, and you have retirement savings. Compare these numbers to $300 to $800 per month for whole life. The difference is staggering. My client's $420,000 mistake. I worked with a client, Tom, age 42, who'd been paying $650 per month for a whole life policy for 8 years. Total paid $62,400. His cash value, $31,000. He was told this was a great investment. I showed him the math. If he'd bought $1 million term life for $75 per month and invested the $575 difference for 8 years at 9% return, he'd have $81,000 in investments. Instead, he had $31,000 in cash value. He was $50,000 behind in just 8 years. We canceled the whole life policy, bought a 20-year $1 million term for $100 per month, and started investing $550 per month in index funds. Over the next 22 years until he retires at age 64, that $550 a month at 8% return will grow to $420,000. That's what his whole life policy cost him in opportunity cost. The buy term and invest the difference strategy. Here's the strategy that works for 98% of people. Step 1. Determine how much coverage you need. Typical rule, 10 to 12 times your annual income. If you make $60,000, get $600,000 to $720,000 in coverage. Consider debts, mortgage, future college costs for kids, and how much your family needs to maintain their lifestyle if you die. Step 2. Buy a 20 to 30-year term policy. Shop online at Policy Genius, select quote, or directly with companies like State Farm, Northwestern Mutual, or Haven Life. Get quotes from 5+ companies. Prices vary significantly. Step 3. Invest the premium difference. Calculate what you would have paid for whole life minus what you're paying for term. Invest that difference in a Roth IRA, taxable brokerage account, or increase your 401k contributions. Step 4. Reassess every 5 years. As you build wealth, you need less insurance. Your mortgage decreases, your investments grow, your kids become independent. You can reduce coverage over time or let the term expire. How to get out of a whole life policy. If you already have whole life insurance, here's how to escape. Option 1. surrender the policy and take the cash value. You'll get a check for whatever cash value has accumulated. It's usually less than you paid in, especially in the first 10 years. Any gain above what you paid in is taxable as ordinary income. Option 2, do a 1035 exchange to a low-cost annuity. This is a tax-free exchange of your whole life policy for a deferred annuity. You preserve the tax-deferred status and often get better growth potential. Option 3, convert to paid-up insurance. Use your cash value to buy a smaller death benefit that requires no more premiums. You maintain some coverage without ongoing payments. Option 4, take the cash value and buy term insurance. Surrender the whole life, use the cash value to fund an emergency fund or invest, and buy term insurance for ongoing coverage needs. Before surrendering, get term insurance in place first. Don't leave yourself uninsured during the transition. What insurance agents won't tell you. Insurance agents are paid to sell policies, not to give unbiased financial advice. Here's what they won't tell you. Their commission on whole life is 5 to 10 times higher than on term life. They make $3,000 to $6,000 on whole life versus $300 to $600 on term. Insurance companies design whole life to be profitable for them, not you. They invest your premiums at 10%, pay you 4%, and keep the difference. The tax-free loan they tout is you borrowing your own money and paying them interest for the privilege. Most whole life policies are surrendered within 10 years, meaning the policyholder lost money and the insurance company kept the premiums. What to do this week? If you're shopping for life insurance, get term life quotes from at least 5 companies. Use Policy Genius or SelectQuote to compare multiple offers at once. If you already have whole life insurance, pull out your policy documents and check your cash value versus total premiums paid. Calculate how much you're behind. Get term life insurance quotes for equivalent coverage. Compare the monthly premium difference. Calculate what investing that premium difference would grow to over the remaining years until retirement. Use a compound interest calculator. If the numbers show you'd be significantly better off with term plus investment, schedule a call with your insurance agent to discuss surrendering or converting the policy. Talk to a fee-only financial advisor if you need help with the decision. Don't take advice from the agent who sold you the policy. They have a conflict of interest. That's all for today. If you found this valuable, hit that like button, subscribe, and ring the notification bell. I drop new finance strategies every week that most creators won't tell you about. Also, visit Own Your Finance blog for more in-depth financial tips and hacks, whether it's insurance strategies, investment optimization, financial planning, and more. Don't forget to download my free guide, Finally Break Free from Living Paycheck to Paycheck, the simple 10-step budget that actually works, and start building real wealth today. Don't miss it. Both links are in the About section. Thanks for watching, and have a great day.